Mark Mobius. This is what Mark Mobius thinks of the Indian equity markets, his views on growth versus recession, the stocks that he's looking at, and a lot more. Listen in.
It'll get worse because I believe the Fed will continue to raise rates because they realize that inflation is still too high in their view. You must remember, central banks, their playbook is to raise rates whenever they have inflation. And so they're going to continue to do that, I believe. And you're going to see higher rates in the US and a slowdown in the economy. Nevertheless, what you see in America is also an incredible amount of savings that have been fed into the economy. And of course, the current administration is pumping more money into the economy by giving, for example, a break people that have loans, student home loans. They're helping them to pay that back. So that's more money going into the economy. So it's a touch and go situation.
Mark, why is India outperforming? Some would argue that Indian markets are expensive, and if interest rates go higher and if inflation is here to stay, then that automatically should impact the P multiple for India.
Well, you must remember that if you compare countries around the world, India looks very, very good, particularly if you look at the big countries. And you have to compare China and India. As you know, China is going through a terrible time now, and the market is very bad. The performance has been very bad. And it looks like the economy in China will continue to be in a bad shape. On the other side, and by the way, exports are very important for China. Whereas for India, they're in a much better position because, yes, you have software exports, which will probably continue to do very well in the face of the effort globally to become more increase productivity and become more efficient. That means the demand for Indian software will continue to be high. But more importantly, the Indian economy is not so much dependent upon exports, upon manufactured exports. And that's good news because you have a domestic economy which is very large and which can feed the growth of companies in India.
Mark, last time when we spoke to you, you had 3 positions in India. Have you made it 4 or have you cut it down to 2?
No, we continue to hold what we have, and we will probably increase as things go forward because, as you know, a lot depends on the status of flows into funds. So into our fund, of course, the flows have been not that high because of the current situation. But as those flows increase, we will be increasing India.
Mark, why is the money market telling us a completely different story? And if I look at some money market watchers, especially global bond fund gurus, they are making a case that, look, the money market is a mature market and the US bond yield, both short term and long term, has inverted, which historically has pointed to a recession.
I think that's one theory, and I think it's quite possible that we will enter into a recession. There's no question about that. Of course, Europe is already almost into a recession already. So depending on how you define a recession, we're definitely in that situation in Europe. And it could spread to the US. But you must remember there are elections coming up in the US. And the Democratic Party will do anything possible to have the economy in good shape when the election comes around, which is why, for example, they released the strategic oil reserves in order to reduce gasoline prices. As you know, gasoline prices at the pump in the US is a very, very important factor because so many people depend on their automobiles to move around.
Mark, one of your big positions in India was Persistent, which was an IT company. And historically, we've seen that whenever there has been a slowdown, at least in developed economies like Europe and like US, it has historically impacted IT companies. What are your thoughts there, Mark? Would you be relooking at your exposure to IT and Persistent in particular?
I believe in the case of Persistent and other IT companies, their future looks very good, even in the face of recession, for one very simple reason. Companies and organizations need to increase efficiency, and the way in the face of the recession. And in order to do that, they've got to take advantage of IT services to a greater extent. So I expect expenditures on IT will probably increase when there is a recession.
Mark, I'd like to draw your attention to the internet stocks, especially the fintech companies globally, names like Tencent, Alibaba, SoftBank, and then Indian companies like Zomato, Policybazaar, Paytm. Do you think this was a fat Humpty Dumpty bubble which has got pricked?
Yeah, I think it's probably a good description. In the face of higher interest rates, these companies that have not been earning money and are in debt are going to be in trouble. There's no question about that. So I think these are companies that should be avoided. Now, not all of them are in that situation. In the case of the Chinese companies you mentioned, their downfall is because of what happened to them as a result of moves by the administration in China to hinder their development, or at least to constrain them. But any company that has not been making money and continues to burn money will be in big trouble, and these are companies to be avoided.
Mark, so what do you make of the crisis in Europe? Given the fact that right now, in Europe you have to choose between eat or heat. There is inflation on one side, which is having impact on your spending power, and there are high energy prices which are sucking out the savings and which are having impact on your energy cost. The problem in Europe on all count is real. And now that winter is coming, what kind of economic ramifications do you think that will have on financial markets?
It would be very bad. And you can look at the euro as one example. The euro now is, I think, it's 90 something cents against the US dollar. And that shows you, it come down from 120 or 120 plus. You can see that the euro has really been bombed out. And I believe it's an indication of confidence in Europe and the euro. So Europe is in big trouble, and they will continue to be unless they get alternative sources of energy. It's not just a matter of the price of gasoline or diesel at the pump. It's a matter of supply to industries. Some industries in Europe have to shut down, or at least close down, close some of their production because of lack of energy or because of higher energy prices. So this is a real crisis in Europe, and will probably get worse during the winter season.
Mark, what is your view on Reliance? This is a company which you've tracked for many years now, and I think you've owned Reliance in the past, then you sold it, then you bought it back. Interesting things are happening now. Here's one company where they've got their, they've managed to really expand their operations in telecom, retail, new energy now. What is your view on Reliance specifically?
Well, we are focusing on the smaller and medium-sized companies, so we don't have Reliance. But I must say, I have to admire Mr. Ambani for what he's done with that company and the way he's expanded it and got into new areas and really have benefited the Indian economy to a great extent in telecoms, in retailing, and so forth. So it's a very admirable company, but I don't have any specific idea regarding their growth and earnings going forward.
Mark, so if you really have to prepare your portfolio and you have to bulletproof your portfolio in this inflationary environment, what is the best hedge? Should one buy into commodities? Should one add gold back? Is it time to increase exposure to hard assets?
I think the best alternative and the best protection now would be equities in companies that have a high return on capital, have good earnings growth, and have no debt or at least very, very low debt. I think companies with those three criteria should do well in this kind of environment. Because you must remember, at the end of the day, equities, good equities, companies that are earning money, are the best protection against inflation because they're able to raise their prices in line with their higher costs and in line with inflation.
So, Mark, at the current juncture, what would you call as your high conviction bets, and where do you think both locally, both globally, and specifically in India, it's time to take some chips off the table?
Well, in India, if you look at our portfolio, we would not take any chips off the table at this stage of the game because we have companies that we think will weather well in this environment. But globally, what we would look for are companies that have a very good handle and good control on IT. Now, it doesn't necessarily mean specific IT companies, software companies, or hardware companies, but it means companies that are able to use IT to increase their productivity. So whether it be consumer, whether it be transport, whether it be manufacturing, whatever industry, those companies that have a good handle on IT and are able to increase their productivity using IT will be the targets for us.
Mark, but in general, do you think next 3-4 years are good for equity markets and especially Indian equity markets? And if I say the anticipated return from Indian markets from the current juncture in next 3 to 4% should be in mid-teens, will that be a fair statement, or that would be a very bullish assumption?
Well, if you select companies of the type that I've just mentioned, equities will beat inflation, simply because the companies that are in good shape will be able to raise their prices higher than inflation. So that's the reason why equities always are a very good bet in an inflationary environment. Yes, there'll be times when the prices of these companies go down and fluctuate, but these companies, though, are going to be the survivors, and they will do very well in the long term.
Mark, what is your view on gold? Given that gold has a reputation of being a hedge against gold, this time, unfortunately, even though inflation is at a record high, gold is not living up to its reputation. Why, and what is your view there?
Well, I think one of the reasons why gold has not done better than what we would expect is because of cryptocurrencies. People are going into cryptocurrencies as a replacement for gold, thinking that it's a good investment. But at the end of the day, if you look at the long-term trend, in an inflationary environment, gold will be a very, very good safe haven. So I always recommend people to have at least 10% of their assets in gold as an emergency currency in case something goes wrong. And if you look at the way money has been printed, devaluation of currencies will continue. And you must remember, inflation is devaluation of currencies. The reason why we have inflation is because currencies have been devalued.
Mark, what is the biggest risk to this market? Is it valuations? Is it inflation? Is it this entire challenge what we have on the energy front?
Well, the biggest risk at the end of the day is currency devaluation because the way governments have been imprinting money means that their currencies will be devalued, and that can lead to very high inflation and a general breakdown of the economy. So at the end of the day, that's what we're looking at, the biggest risk.